On August 1, 2012, at 9:29 a.m., the New York Stock Exchange was a picture of controlled potential. It was an ocean of screens, a symphony of quiet keystrokes. Men and women in crisp shirts stood ready, their eyes fixed on the numbers. They sipped their morning coffee, the bitter taste a familiar prelude to the day's battle. Knight Capital Group was a titan in this world. They did this not with gut feelings, but with algorithms. At precisely 9:30 a.m., the opening bell rang, and the future broke. A torrent of orders, nonsensical and wild, began to flood the market. Screens that should have been a mix of green and red turned into a bloodbath of crimson alerts. To understand the collapse, you have to understand the software. It was named SMARS, a clunky acronym for Smart Market Access Routing System. The name sounds complex, but its job was simple, at least in theory. SMARS was the brain. It received an order to buy a stock. It received an order to sell a stock. It decided which of the many exchanges was the best place to execute that trade. In the world of high-frequency trading, microseconds are the currency of profit. The seeds of the disaster were planted 8 years earlier. Back in 2005, a feature was retired. Programmers call this dead code. The new code was deployed incorrectly to one of the 8 servers. The forgotten switch was flipped. The old retired function suddenly woke. It was now live, and it was connected to the live market. The numbers behind the Knight Capital disaster are as stark as they are terrifying. It was making them at a speed that defied human intervention. The awakened algorithm began executing orders for 154 different stocks listed on the New York Stock Exchange. In the space of 45 minutes, it spewed millions of individual trades into the market. In the most intense moments, the firm was losing approximately $10 million per minute. That breaks down to about 175,000 every single second. The final tally, a pre-tax loss of $461.1 million. The system had effectively bought shares for around $7 billion and sold them for about $6.54 billion. That $460 million difference was the price of a single deployment error, the cost of a single piece of forgotten code. The algorithm forced the company to execute the single worst trading strategy imaginable: buy high, sell low, on a scale that could bankrupt a nation. The first sign of trouble was not an alarm bell, but a wave of confusion. Traders saw prices for mundane stocks like Goodyear Tire and Rubber, Harley-Davidson suddenly jump by 10%, 20%, 150% in the opening minutes. Phones began to ring, a cacophony of panicked voices asking, "What is going on?" Their own systems vomited orders into the market. The profit and loss column flashed a deeper and deeper red. Engineers, managers, they swarmed the server room. They tried issuing kill commands. The system, overwhelmed with bad data, didn't respond. They tried disabling the trading gateway. For 45 agonizing minutes, the team fought their own creation. The machine was winning. It was faster, more relentless. Finally, they found a solution. It wasn't elegant. They resorted to a crude, manual shutdown. The torrent of orders stopped. An eerie silence fell over the trading desks. The team stared at the carnage, the massive, toxic positions they now owned, the 9-figure hole that had been blown in the side of their company, the $460 million loss. Not just an accounting problem, it was a capital crisis. Knight's net capital had been decimated. The Securities and Exchange Commission was on the phone. The firm's clearinghouses were demanding assurances. Knight Capital was technically insolvent. The clock was ticking. Knight began the day with shareholder equity of about $1.5 billion. The loss represented nearly a third of that. The firm's excess net capital was only about $365 million. The company's own stock, ticker symbol KCG, plummeted. It fell over 75% in 2 days. Employees stood in stunned silence, watching the value of their own stock options evaporate in real time. The battle was over. The war for survival had just begun. This isn't a story about a bad bet or a market crash. It is a ghost story for the digital age. With the firm on the brink of collapse, CEO Thomas Joyce began a desperate 48-hour marathon of phone calls. He was begging for a lifeline. He called every major player on Wall Street, JP Morgan Chase, Goldman Sachs, private equity firms, rival trading houses. The sharks began to circle. A company in distress is an opportunity. Several firms saw a chance: Jefferies, Blackstone, Getco. The potential saviors knew this. They held all the leverage. They could dictate the terms, and the terms would be painful. The rescue came in the form of a $400 million convertible bond deal, led by a consortium including Getco. The terms were so dilutive that existing shareholders were virtually wiped out. Getco merged with Knight months later. The combined entity was renamed KCG Holdings, and Getco's CEO took the top job. The old Knight capital was gone, swallowed by a competitor that had capitalized on its single fatal mistake. The post-mortem revealed a chain of small human errors that cascaded into a technological catastrophe. Leaving it in was easier. A bit of technical debt accruing invisible interest for 8 years. The process was manual. On one server, the old code that should have been replaced was not. Instead, the new code was placed in a different directory. The kind of mistake anyone could make. The third and most critical failure was the repurposing of the PowerPeg function. The flag was still wired to a graveyard. On 7 servers, the signals did nothing. On the 8th, the dead code answered. No single person was the villain. It was a systems failure, of process, of testing, and of institutional memory. They built a powerful engine but failed to keep a complete blueprint of its design, including forgotten corners and abandoned rooms. Small, forgotten compromises can harbor immense potential for failure. They are the ghosts waiting for a door to be opened. One switch, one flag, one oversight, 45 minutes of ruin. In the wake of the Knight disaster, the industry and its regulators made a familiar promise: never again. The SEC ultimately fining Knight $12 million for its inadequate risk controls. Exchanges began to implement new kill switches, pre-trade risk checks, circuit breakers for individual firms. Firms invested heavily in new layers of control. Better code, better testing, better oversight. Yet, a shadow of doubt remains. Technology has not stood still. Trading systems have only become faster, more complex, more interconnected. The rise of machine learning and artificial intelligence in trading introduces new layers of opacity. The market rewards speed, but speed is the enemy of caution. Every safeguard adds microseconds that can mean profit or loss. The pressure to move faster, to deploy new code quicker, and to cut corners is a constant, powerful force. The promise of prevention is always at war with the lure of profit. The story of Knight Capital is more than a tale of a technical glitch. We surround ourselves with the language of command and control. We write the code. We build the servers. We flip the switches. We tell ourselves that we are the masters, and they are the servants. This is the great illusion of the digital age. When the machine began its rampage, the humans were helpless. Their kill switches failed. Their commands were ignored. It was a stark demonstration of where the real power lies when speed exceeds comprehension. We have filled our world with ghosts, dormant code, hidden variables, unforeseen interactions. As these systems grow ever more powerful and opaque, we must confront the real possibility that our control is merely a comforting fiction. In a world run by code, who is actually in control? Subscribe if you believe the system is rigged. Comment below, what would you do if you saw 400 million vanish in front of your eyes?